He is arguably the greatest financial mind of the last century, an icon of capitalism, a folk hero of personal finance, a man whose annual letters are treated like scripture by an army of devoted followers. Warren Buffett. His name is synonymous with picking stocks, with finding those golden needles in the haystack of the global economy. He bought American Express when the world thought it was finished. He bought Coca-Cola when Wall Street called it a tired brand. He built a $500 billion empire, Berkshire Hathaway, by making concentrated, high-conviction bets on individual companies. He is the undisputed champion of active investing. So, what is the #1 investment he recommends for his family, for his friends, for you? What is the single stock he has championed more than any other for the average person seeking financial freedom? The answer is profoundly simple, almost anticlimactically so. It's a stock you likely already own, or at least have exposure to in your retirement account. It is the Standard & Poor's 500 Index, a low-cost fund that simply buys and holds the 500 largest publicly traded companies in America. That's it. That's the secret. The Oracle of Omaha, the master stock picker, tells the vast majority of people not to pick stocks at all. This seems like a paradox, a contradiction at the very heart of his philosophy. Why would the world's greatest fisherman tell everyone else not to fish, but to simply buy a share of the entire ocean? The answer to that question isn't just a piece of financial advice. It is a masterclass in psychology, a lesson in humility, and the key to unlocking a powerful and reliable engine for wealth creation. It is the culmination of a lifetime spent observing not just balance sheets and income statements, but the fatal flaws of human nature. This strategy is designed to prevent the single most costly mistake an investor can make, the mistake of trying to be clever. It is a financial transformation waiting to happen, a way to beat the vast majority of highly paid professionals on Wall Street by doing almost nothing. To understand the depth and power of this recommendation, we must go beyond the simple advice and deconstruct the 5 foundational pillars upon which it is built. We must begin with the story of a bet, a public, decade-long million-dollar wager that pitted Warren Buffett against the best and brightest of the hedge fund world. It was a battle not just of financial returns, but of 2 opposing philosophies, and its outcome reveals everything you need to know about how to truly win the game of money. The first and most important pillar of Buffett's thesis is a stark and uncomfortable truth: the relentless pursuit of market-beating returns, the very business of Wall Street, is for most people a fool's errand. The world of active management, with its star fund managers, complex strategies, and astronomical fees, is a game heavily rigged against the end investor. Buffett knew this not just from data, but from a deep understanding of the industry's structure, and to prove his point in the most public way imaginable, he laid down a challenge. This brings us to a foundational anecdote, a story that should be required reading for anyone with a retirement account. It is the story of the long bet. In 2007, the financial world was drunk on its own success. The markets were roaring, and the kings of this universe were the hedge fund managers. They were the new masters of the universe, armed with proprietary algorithms, PhDs in physics, and a level of confidence that bordered on hubris. They charged immense fees for their supposed genius, typically 2 and 20, a 2% management fee on all assets, plus 20% of any profits. They promised their wealthy clients what every investor dreams of: high returns with low risk, the ability to zig when the market zagged, to deliver alpha, the mythical ability to consistently outperform the market averages. Buffett, from his quiet office in Omaha, saw this for what it was: a giant marketing scheme. He saw an industry that was brilliant at gathering assets and generating fees, but shockingly poor at delivering on its central promise. So in his 2005 annual letter, he threw down the gauntlet. He publicly offered to wager a substantial sum that over a 10-year period, a simple, unmanaged, low-cost S&P 500 index fund would outperform a portfolio of actively managed hedge funds. For 2 years, there were no takers. The masters of the universe were strangely quiet. It was, after all, a terrible bet for them to take. If they won, they would have merely beaten an old man's simple wager. If they lost, it would undermine the very foundation of their multi-trillion-dollar industry. But finally, one firm stepped forward. Protégé Partners, a specialized asset manager that invested in a collection of different hedge funds, what's known as a fund of funds, accepted the challenge. Their principal, a man named Ted Seides, was confident. He and his team would select 5 of the best funds of funds, which in turn would collectively hold stakes in over 200 individual hedge funds. This was the best of the best, the cream of the crop, a diversified portfolio of supposed financial geniuses. The terms were set. The bet would run for 10 years, from January 1, 2008 to December 31, 2017. Each side put up approximately $320,000 to be invested in a zero-coupon treasury bond that would be worth $1 million at the bet's conclusion. The winner would get to donate the $1 million to the charity of their choice. Buffett chose Girls Inc. of Omaha. Protégé Partners chose Absolute Return for Kids. The stage was set. It was the ultimate test. The simple, passive, low-cost index versus the complex, active, high-cost Wall Street machine. The starting gun fired on January 1, 2008, and immediately, the world fell apart. The global financial crisis hit with the force of a hurricane. In 2008, the S&P 500 index fund, Buffett's horse in the race, plummeted by a staggering 37%. The hedge funds, with their mandate to protect capital and hedge against downturns, did much better. They lost only 23.9%. In year 1, the supposed geniuses of wealth management were trouncing the simple index. The financial press took note. Was Buffett's old-fashioned wisdom finally obsolete? Had the sophisticated strategies of modern finance finally conquered the simple logic of passive investing? Ted Seides and Protégé Partners were looking smart. But Buffett, a man who has seen more market cycles than almost anyone alive, was unconcerned. He preaches long-term investing, and this was a 10-year bet. Then, the slow, methodical power of Buffett's logic began to assert itself. In 2009, as the market began its long recovery, the S&P 500 roared back, gaining 26.6%. The hedge funds gained only 15.9%. The gap was closing. The pattern repeated in 2010. The S&P was up 15.1%. The hedge funds, a meager 5.2%. By 2011, the simple index fund had already overtaken the high-priced experts, and from there it was a slaughter. In 2012, the S&P gained 16%, the funds of funds just 3.4%. In 2013, a banner year for the market, the index soared by 32.3%, while the hedge funds managed just 11.6%. Year after year, the results were posted, and the story was the same. The S&P 500, that simple, boring, unmanaged collection of America's greatest businesses, was systematically dismantling the best and brightest that Wall Street had to offer. By the time the bet entered its final years, the outcome was no longer in doubt. In fact, in May of 2017, with more than half a year left to go, Ted Seides conceded defeat in a column for Bloomberg. He wrote, with admirable grace, "For all intents and purposes, the game is over. I lost." The final numbers were devastating. Over the 10-year period, the simple S&P 500 index fund that Buffett had chosen, a Vanguard Admiral share class fund, had delivered an average annual return of 7.1%. The 5 funds of funds selected by Protégé Partners had delivered an average annual return of just 2.2%. Let that sink in. A portfolio designed and managed by hundreds of the highest-paid people in finance, actively trading, shorting stocks, using leverage, and employing every complex strategy in their arsenal, had been beaten. Not just beaten, but annihilated. The index fund's total gain over the decade was over 85%. The hedge fund's total gain was a pathetic 22%. An investment of $1 million in the S&P 500 would have grown to over $1.85 million. The same million in the hedge funds would have grown to just $1.22 million. The difference wasn't a rounding error. It was life-changing money left on the table. The so-called smart money had been exposed. The $1 million prize went to Girls Inc. of Omaha, but the real prize was the lesson, a lesson worth trillions to the investing public. The futile, high-cost game of active management was, for the vast majority, a loser's game. The question is, why? Why do so many people, both professionals and amateurs, fall into this trap? This leads us to the underlying psychological principle at play. It's a toxic cocktail of cognitive biases, but the most powerful among them is the overconfidence bias, coupled with the illusion of control. Overconfidence bias is the well-documented human tendency to overestimate our own knowledge, abilities, and the precision of our information. In the context of investing, it's the voice in our head that says, "I'm smarter than average. I've done my research. I can pick the winners and avoid the losers." This bias is particularly potent in fields that are perceived to reward intelligence, like finance. The entire culture of Wall Street is built on this premise. The sharp suits, the complex jargon, the Ivy League degrees, it's all designed to project an aura of superior intellect that can outwit the market. The problem is, the market is not an opponent you can outsmart in the traditional sense. It's a massively complex adaptive system, a dynamic reflection of the hopes, fears, and actions of millions of participants, all processing information simultaneously. Having a high IQ or reading the Wall Street Journal every day does not give you a sustainable edge against that collective intelligence. This overconfidence is supercharged by the illusion of control. This is our innate belief that we can influence outcomes that are, in reality, largely determined by chance. When we actively pick a stock, we feel in control. We chose it. We're monitoring it. We're driving the car. Buying an index fund, by contrast, feels passive. It feels like admitting you can't drive and are just hiring a bus to take you to your destination. The active approach satisfies our deep-seated psychological need for agency. The financial media feeds this illusion relentlessly. Every day, pundits on television offer confident predictions about where the market is headed. They analyze chart patterns, debate Federal Reserve policy, and recommend hot stocks. This creates the impression that the future is knowable, and that with the right information or the right guide, you can navigate it for profit. It's an intoxicating narrative, but it's a dangerous fiction. Buffett's genius is in his humility. He acknowledges that while he can identify a great business, he has no idea what the stock market will do tomorrow, next month, or next year. By recommending an index fund, he is telling people to relinquish the illusion of control and embrace the statistical reality. So how do we translate this into a practical, actionable blueprint for our own financial lives? The mental model here is what we can call the Know Your Place portfolio audit. It is a simple three-step process to align your investment strategy with reality, not ego. Step 1 is radical acceptance of the data. You must internalize the evidence from the Buffett protégé bet and countless other academic studies. More than 90% of active fund managers fail to beat their benchmark index over any 10 to 15-year period. The odds are monumentally stacked against you. Accept that you and the vast majority of professionals you could hire are not the exception. This is not a judgment of your intelligence. It is an acknowledgement of the nature of the game. Step 2 is to conduct a forensic analysis of your costs. You must become a ruthless detective hunting down every single fee that is eating away at your returns. Go through all your investment accounts, your 401k, your IRA, your brokerage account, and find the expense ratio for every fund you own. Add in any advisory fees, trading commissions, or account maintenance fees. Calculate your all-in cost as a percentage of your assets. Be prepared for a shock. Many people are unknowingly paying 1%, 2%, or even more per year. Step 3 is the final, brutal comparison. Look up the performance of your portfolio over the last 1, 5, and 10 years after your all-in fees have been deducted. Now, Compare that number to the performance of a simple, low-cost S&P 500 index fund like VOO or SPY over the same periods. In almost all cases, the conclusion will be inescapable. You have been paying more for less. This audit forces you to confront the financial consequences of active management and makes the switch to a low-cost, passive strategy not an act of surrender, but a profoundly rational and empowering executive decision-making process for your own life. To truly appreciate the wisdom of this path, we must examine its opposite. We must walk the path of the 99%, the path of the typical investor caught in the siren song of active management. This antithetical approach is one of emotional turmoil and financial disappointment. It often begins with a story. A friend at a barbecue mentions a small tech company that's developing a revolutionary new product. You hear a stock guru on TV breathlessly touting the next Amazon. You see a stock's ticker symbol all over social media, accompanied by rocket ship emojis. This is the lure of the hot tip. It bypasses rational analysis and plugs directly into our fear of missing out, our greed, and our desire for a shortcut to wealth. So the investor takes the plunge. They buy the stock, often after it has already seen a significant run-up in price. For a while, it might even work. The stock climbs, and the investor feels like a genius. They've beaten the system. They check the stock price 10 times a day, their mood rising and falling with each tick of the chart. They have confused luck with skill. Then, inevitably, reality sets in. The company misses an earnings target. A competitor emerges, the market sentiment shifts, the hot stock begins to fall. The initial euphoria turns to anxiety, then to panic. The investor who felt like a genius now feels like a fool. They tell themselves it will bounce back, but the losses mount. Finally, unable to stomach the pain any longer, they sell, often near the bottom, locking in their losses. They have perfectly executed the cardinal sin of investing: buy high, sell low. They then swear off individual stocks, only to be lured back into the game months or years later by the next can't-miss story. This cycle of hope, greed, fear, and capitulation is the lived experience of millions of investors. They are not investing, they are gambling. They are treating the stock market like a casino, and the house always wins. They expend enormous amounts of mental and emotional energy, only to achieve results that are far worse than if they had simply bought the whole market and gone on with their lives. This is the costly, stressful, and ultimately futile path that Buffett's advice is designed to save you from. Finally, let's connect this principle directly to the numbers. How does the choice between active and passive management manifest on a balance sheet or in a retirement account? The direct financial connection is a concept we can call the compounding cannibal. Fees, especially in the world of wealth management, are like a parasite. They are small and often go unnoticed, but over time, they consume a massive portion of their host's wealth. Imagine two investors, both starting with $100,000 at age 30. Both invest for 30 years and are fortunate enough to be in funds that track the same basket of stocks, which we'll say grows at an average of 8% per year before fees. Investor A chooses a low-cost S&P 500 index fund with an expense ratio of 0.04%. Investor B chooses an actively managed mutual fund with a seemingly reasonable expense ratio of 1.25%, a common figure in the industry. For the first few years, the difference seems trivial. After 1 year, Investor A has $107.960. Investor B has $106.750, a difference of about $1.200. No big deal, right? But compound interest works on the money you keep, and it works against the money you pay in fees. The fee doesn't just cost you the percentage you pay each year. It costs you all the future growth that money would have generated. Let's fast forward 10 years. Investor A, the passive indexer, now has $215.637. Investor B, the active investor, has $192.236. The gap has widened to over $23,000. That's the price of a decent car, vanished into the pockets of the fund management company. Now let's go to the 30-year mark. at retirement age 60. Investor A, with their tiny 0.04% fee, has a portfolio worth $1,002,238. They are a millionaire. Investor B, with their 1.25% fee, has just $684,845. The compounding cannibal of fees has devoured over $317,000 of their potential wealth. That is a staggering sum. It represents a more luxurious retirement, a paid-off home, the ability to help children and grandchildren, or simply years of financial peace of mind. It is a life-altering difference, all stemming from a seemingly small percentage point on a prospectus. The Buffett bet wasn't just an academic exercise. He was demonstrating this mathematical certainty. The hedge funds underperformed not just because of poor investment choices, but because they were running a race with lead weights strapped to their ankles, layers upon layers of fees that acted as an inescapable drag on performance. Choosing low-cost index fund investing isn't just a strategy. It is the single most powerful defense against the silent theft of your future wealth. This brings us to the second great pillar of Buffett's argument. If active management is a loser's game, why is the alternative, passively owning the S&P 500, such a winner's game? The answer lies in understanding what you are truly buying. You are not buying a ticker symbol. You are not buying a piece of data on a screen. You are buying a non-voting partnership stake in the 500 most powerful, innovative, and resilient companies in the United States, and by extension, the world. You are harnessing the relentless, multi-decade tailwind of American capitalism. This is about the unstoppable power of owning American business. Perhaps no story better illustrates Buffett's core conviction in this principle than his actions during the darkest days of the modern era. The foundational anecdote here is not about a specific stock purchase, but about a public declaration of faith. The date was October 16, 2008. The global financial system was in free fall. Lehman Brothers had collapsed a month earlier. The credit markets were frozen. The Dow Jones Industrial Average was plummeting daily. Fear was not just in the air, it was the air. The overwhelming sentiment, from Wall Street to Main Street, was that this was the big one, an economic apocalypse from which there might be no recovery. The headlines were filled with talk of a new Great Depression. People were pulling their money out of the market in a state of sheer panic. And on that day, Warren Buffett published an op-ed in the New York Times. The headline was simple and direct: "Buy American, I am." In the article, he stated plainly that he was moving his personal cash reserves out of safe U.S. Treasury bills and into U.S. stocks. He admitted he had no idea if the market would be lower in a month or a year. But he was certain of one thing: over the long term, the market would be higher, much higher. He wrote, and this is a crucial quote, "A simple rule dictates my buying: be fearful when others are greedy, and be greedy only when others are fearful." He went on to say, over the long term, the stock market news will be good. In the 20th century, the United States endured 2 world wars and other traumatic and expensive military conflicts, the Depression, a dozen or so recessions and financial panics, oil shocks, a flu epidemic, and the resignation of a disgraced president. Yet the Dow rose from 66 to 11,497. He wasn't recommending a specific company. He was making a macro-level bet on the fundamental strength and dynamism of the American economic engine. He was buying a piece of the whole system. While everyone else was staring at the terrifying waves crashing on the shore, Buffett was focused on the powerful incoming tide of long-term economic progress. Buying an S&P 500 index fund is the democratization of this exact philosophy. It allows any investor with any amount of money to make the same broad, powerful bet on the future productivity of America that Buffett himself was making with his billions. His op-ed was not a market call, it was a history lesson and a vote of confidence in the system that has generated more wealth than any other in human history. The psychological principle that makes this long-term perspective so difficult for most people to maintain is a 1-2 punch of cognitive biases: recency bias, and myopic loss aversion. Recency bias is our natural tendency to give greater importance to recent events than to events in the distant past. When the market is crashing, our brains don't think about the 100-year upward trend of the stock market. We fixate on the terrifying, painful losses of the last week or month. We extrapolate that recent trend into the future, assuming that the losses will continue indefinitely. This bias is what fuels panic selling. It convinces us that this time is different, even though history is littered with crises that, in retrospect, were incredible long-term buying opportunities. The 2008 financial crisis, the dot-com bust, the Black Monday crash of 1987, they all felt like the end of the world at the time, and they were all followed by powerful bull markets. Compounding this is myopic loss aversion. Groundbreaking research by economists Daniel Kahneman and Amos Tversky showed that humans feel the pain of a loss approximately twice as powerfully as they feel the pleasure of an equivalent gain. Losing $1,000 hurts as much as gaining $2,000 feels good. Myopic refers to our tendency to evaluate our portfolios over short time horizons. If you check your portfolio every day, you are subjecting yourself to a constant stream of these painful little losses during any market downturn. This emotional barrage wears you down, making it almost impossible to stick to a long-term plan. The combination is lethal. Recency bias makes the current downturn feel permanent, and myopic loss aversion makes the daily pain of that downturn unbearable. This is the psychological mechanism that drives investors to sell low. The beauty of a passive index fund strategy, especially when automated, is that it acts as a powerful antidote to these biases. It encourages you to think in terms of decades, not days. It shifts your focus from the chaotic noise of short-term price movements to the powerful signal of long-term economic growth. How can you build a system to operationalize this long-term thinking? The applied mental model is what I call the autopilot wealth machine. It's a 4-step blueprint to build a portfolio that thrives on long-term trends and is resilient to short-term emotional shocks. Step 1 is to choose your vessel. Select a very low-cost S&P 500 index fund or a broad total stock market index fund. The specific fund matters far less than its cost. You are looking for an expense ratio under 0.1%, and ideally under 0.05%. This is your core holding, the engine of your wealth creation. Step 2 is to automate the fuel supply. Set up automatic recurring investments from your checking account into this fund every single payday. This is known as dollar cost averaging. When the market is high, your fixed dollar amount buys fewer shares. When the market is low, the same amount buys more shares. This removes emotion from the buying decision entirely and ensures you are systematically buying more when prices are cheapest. You are mechanically being greedy when others are fearful. Step 3 is to set your destination and ignore the weather. You must commit, ideally in writing, to a time horizon. This is not a get-rich-quick scheme. You are investing for retirement, for financial independence in 10, 20, or 30 years. This long-term focus allows you to mentally ride out the inevitable storms along the way. A 20% market drop is terrifying if you need the money next year. It's a temporary sale if your time horizon is 20 years. Step 4 is to install a navigation system. This is your rebalancing rule. Perhaps once a year you will check your asset allocation. If your plan is to be 90% stocks and 10% bonds, and a strong stock market run has pushed that to 95/5, you will sell some stocks and buy some bonds to get back to your target. This imposes a disciplined, non-emotional way to sell high and buy low. This 4-step process creates a robust system that protects you from your own worst psychological instincts and puts the power of American economic growth directly to work for you. The antithesis of this calm, systematic approach is the frantic and destructive path of the market timer. The market timer believes they can be nimble, dancing in and out of the market to catch the upswings and avoid the downturns. Their life is one of constant anxiety. They are glued to financial news channels trying to interpret every word from the Federal Reserve Chairman. They read newsletters from market gurus who claim to have a secret system for predicting the market's next move. They look at complex charts with moving averages and support levels, believing they can divine the future from the patterns of the past. They live in a state of perpetual tension, torn between the fear of missing a rally and the fear of being caught in a crash. They often end up doing the exact opposite of what they intend. They get nervous after a small drop and sell, only to watch the market rebound without them. Then, filled with regret, they buy back in at a higher price than where they sold. They have managed to turn a winning investment into a losing trade. The data on market timing is unequivocal. It's a fool's game. According to analysis by J.P. Morgan Asset Management, if you had stayed fully invested in the S&P 500 from 1999 to 2018, a $10,000 investment would have grown to over $30,000. But if you had tried to time the market and missed just the 10 best trading days over that 20-year period, your return would have been cut in half, growing to only $15,000. If you missed the 20 best days, your return was essentially zero. The market's biggest gains often come in sharp, unpredictable bursts, frequently in the days immediately following the biggest drops. By trying to avoid the bad days, you almost inevitably miss the best days, and that is a catastrophic error for your long-term wealth. The market timer expends 100 times the effort for half the returns, a truly disastrous equation. The direct financial connection here is the raw, explosive power of compound growth when applied to the engine of the U.S. economy. An S&P 500 index fund is not a magical black box. It is a direct ownership stake in the retained earnings and future profits of America's leading companies. Think about what you own. You own a piece of Apple's next iPhone, a slice of Amazon's cloud computing business, a share of Johnson & Johnson's medical breakthroughs, a fraction of Visa's global payment network. These companies are not just sitting still, they are innovating, expanding, and becoming more efficient. They reinvest their profits to create even more profits in the future. This is the micro-level engine of growth. On a macro level, this is tied to the growth of the entire economy. If you were to overlay a chart of U.S. gross domestic product, GDP, with a chart of the S&P 500's earnings over the last 70 years, you would see two lines marching upwards together in near-perfect lockstep. The stock market, over the long run, is a direct reflection of the nation's economic output. By owning the index, you are ensuring that as the country as a whole becomes more productive and wealthier, your personal wealth grows right along with it. This is the most powerful and reliable tailwind an investor can have. It turns the daunting task of building a retirement portfolio from a stressful game of stock picking into a simple act of participation in the greatest wealth creation machine the world has ever known. However, even with the right investment vehicle, there is a silent killer that can sabotage this entire process. A hidden force that drains wealth, year after year, with such subtlety that most investors don't even notice until it's too late. This brings us to pillar number 3, the absolute unyielding tyranny of costs. Buffett understood, perhaps better than anyone, that in the world of investing, you don't get what you pay for. In fact, more often than not, the more you pay, the less you get. Minimizing costs is not a minor detail in a successful investment strategy. It is the central battlefield where the war for your financial freedom is won or lost. To understand Buffett's deep-rooted obsession with costs, we must travel back in time to his very first investment partnership in 1956. The anecdote is not about a stock he bought, but about the revolutionary way he structured his fees. At just 25 years old, Buffett pooled money from a small group of family and friends in Omaha, but he refused to set up his partnership like a typical money manager. The standard model then, as now, was to charge a fee based on the amount of assets under management, AUM. You give a manager $1 million, they charge you 1% or 2% every year, regardless of whether they make you or lose you money. Buffett saw this as fundamentally unfair. It incentivized the manager to gather assets, not to perform. So he created a structure that is almost unheard of today in its alignment with investor interests. First, he established a 6% annual hurdle rate. This meant that his investors had to earn a 6% return on their money, roughly the return of a safe government bond at the time, before he saw a single penny in fees. He got paid only for performance above this baseline. Second, he took no annual management fee. Zero. His entire compensation was based on performance. Third, above that 6% hurdle, he would take just 25% of the profits. This structure was a masterstroke. It told his partners, "We are in this together. I only win if you win first, and win big." Compare this to the modern hedge fund model of 2 and 20, or the typical wealth management fee of 1% of assets. These models ensure the manager gets rich from fees, even if their clients get mediocre returns. Buffett's early fee structure reveals a core tenet of his philosophy. Costs are not just an expense. They are a direct transfer of wealth from your pocket to the managers, and they must be ruthlessly minimized. Why are most investors so blind to the devastating impact of these costs? The underlying psychological principle at play is a combination of salience bias and what we can call percentage numbness. Salience bias describes our tendency to focus on things that are prominent or emotionally striking, while ignoring things that are less obvious. A 20% market crash is highly salient, it's dramatic, scary, and captures all of our attention. A 1.5% annual management fee, on the other hand, is completely non-salient. It's a small number, buried in the fine print of a prospectus. It's deducted automatically from your account, so you never have to write a check or feel the pain of paying. It's a silent, invisible drain. Our brains are simply not wired to perceive this kind of slow, steady leakage as a major threat. This is compounded by percentage numbness. We are notoriously bad at intuitively understanding the long-term compounding effect of small percentages. If you're buying a car and the salesperson offers a 1.5% discount, it feels almost meaningless. We apply that same flawed intuition to investment fees, failing to grasp the exponential damage they inflict over time. A 1.5% fee doesn't sound like a lot. It doesn't trigger the same mental alarm bells as a 50% loss. But that fee isn't a one-time charge. It's a perpetual tax on your entire nest egg, year after year, decade after decade. It's like trying to fill a bucket that has a small, constant leak. At first, you barely notice the water level is a bit lower, but over 30 or 40 years, you realize the leak has drained half the bucket. Buffett's advice to use low-cost index funds is a direct countermeasure to these psychological blind spots. It forces the issue of cost to the forefront, making it a primary factor in the investment decision, right where it belongs. To combat this blindness, you need a practical tool, an applied mental model to make the invisible visible. Let's call it the fee X-ray. This is a 5-step process to diagnose the true cost of your portfolio and understand its long-term impact. Step 1 is to gather the evidence. Collect the most recent statements for every single investment account you have. 401k, 403b, IRA, Roth IRA, taxable brokerage accounts. Everything. Step 2 is to identify the expense ratios. For each mutual fund or ETF you own, you must find this number. It will be listed as a percentage on the fund's summary page on websites like Morningstar or Yahoo Finance, or buried in the fund's prospectus. Write it down next to the name of each fund. Step 3 is to uncover the hidden fees. Are you paying an advisor a fee based on your assets? Add that percentage. Are there annual account fees, trading commissions, or other administrative charges? Add them all up to get your true all-in annual cost. Step 4 is the critical benchmark comparison. Now look up the expense ratio of a broad, low-cost index fund from a provider like Vanguard, Fidelity, or Schwab. You will see numbers like 0.03% or 0.04%. Place this number next to your own portfolio's all-in cost. The difference will likely be shocking. Step 5 is to calculate the 30-year fee impact. Use a free online investment fee calculator. Plug in your current portfolio value, your estimated annual contribution, your estimated rate of return, and then run the calculation twice, once with your current all-in fee and once with the ultra-low index fund fee. The resulting dollar amount, the fee impact, is the amount of your future wealth that you are currently on track to transfer to the financial industry. Seeing that number, often hundreds of thousands of dollars in black and white, transforms the non-salient fee into a highly salient, emotionally powerful motivator for change. The path of the 99%, the antithesis to this cost-conscious approach, is to fall for the premium product illusion. Wall Street is a marketing machine, and its most profitable products are high-cost, actively managed funds. These funds are sold, not bought. They are wrapped in glossy brochures and sophisticated-sounding language. They promise things like, quote, tactical asset allocation, proprietary quantitative models, downside protection, and alpha generation. This language is designed to make the investor feel like they are getting access to something special, something exclusive that justifies the higher price tag. It preys on our insecurity, the feeling that investing is complicated, and we need an expensive expert to navigate it for us. The reality, as shown by the data, is that these promises are overwhelmingly empty. You are paying for a fancy label on a product that is statistically likely to underperform a cheaper generic version. It's like choosing a designer brand of water that costs $10 a bottle over clean, safe tap water. The marketing is better, the bottle looks nicer, but the underlying product is inferior. The investor who chooses the high-cost fund believes they are being discerning and sophisticated. In reality, they are often the least sophisticated person in the transaction, the mark in a very profitable game. They are buying a story, and it is a very, very expensive story. Let's bring this down to the cold, hard numbers on your future balance sheet. The direct financial connection is nothing short of balance sheet erosion. Imagine a tale of two twin sisters, both diligent savers. At age 25, they each start investing $500 per month for retirement. Sister A, a follower of Buffett's advice, puts her money into a low-cost S&P 500 index fund with an all-in cost of 0.10%. This includes a bit for account fees. Sister B goes to a traditional financial advisor who puts her in a portfolio of actively managed funds with an average all-in cost of 1.5%. We'll assume both portfolios earn a gross average of 8% per year over the next 40 years. At age 35, after 10 years of investing, Sister A has $90, $345. Sister B has $82, $341. A difference of about $8,000. Annoying, but not yet catastrophic. At age 45, after 20 years, Sister A has $292, $860. Sister B has $242, $974. The gap has exploded to nearly $50,000. That's a full year's salary for many people, simply vanished. At age 55, after 30 years, Sister A has $745, $183. Sister B has $564, $364. The tyranny of costs has now eroded over $180,000 from her nest egg. Now let's look at the final tally at retirement age 65. Sister A, the low-cost investor, has a final portfolio value of $1,777, $159. Sister B, the high-cost investor, has just $1,227, $156. The final cost of that premium advice was a staggering $550, $003. Sister B will have to work for several more years or accept a significantly lower standard of living in retirement, all because of a seemingly small 1.4% difference in annual fees. This is not a theoretical exercise, this is the mathematical reality for millions of investors. Controlling costs is the most predictable and most impactful lever you can pull to maximize your long-term financial success. This leads us directly to the fourth pillar, a principle that ties all the others together and is perhaps most reflective of Buffett's personal character, the profound virtue of simplicity and patience. In a world that constantly pushes for more complexity, more action, and more information, Buffett's approach is a radical statement that in investing, less is almost always more. The greatest challenge is not finding the next hot stock, but cultivating the emotional discipline to do nothing. A simple plan, patiently executed over a long period of time, will outperform a complex plan, actively managed in a state of constant anxiety. There is a wonderful anecdote that perfectly illustrates Buffett's mental framework for dealing with complexity. It's the story of the too hard pile. For decades, investors have watched Buffett and his partner Charlie Munger make brilliant investments in industries they understand deeply: insurance, banking, consumer goods, railroads. But they have also watched him famously sit out some of the biggest crazes. He largely avoided the dot-com bubble of the late 1990s, enduring years of criticism that he had lost his touch and didn't understand the new economy. He was right. He didn't understand it, and that was the key. Buffett has often described his decision-making process as sorting business propositions into 3 mental trays on his desk. The first is the in tray, for ideas that are simple, understandable, have a durable competitive advantage, and are run by able and honest management. These are the rare opportunities he acts on. The second is the out tray, for ideas that are clearly bad. The third, and by far the largest, is the too hard tray. Into this tray go all the businesses he doesn't understand, the complex technologies, the industries with unpredictable futures, the situations where he feels he has no analytical edge. He doesn't waste a moment of mental energy on them. He simply acknowledges their complexity and moves on. This is a profound lesson in intellectual humility. By recommending an S&P 500 index fund, Buffett is giving the average person permission to do the same. You don't need to understand biotechnology, enterprise software, or semiconductor manufacturing. You don't need to have an opinion on every company in the market. You can place the entire endeavor of stock picking and market timing into your too hard pile, and instead choose the simple, elegant, and effective solution of owning them all. Simplicity is not an admission of ignorance. It is the highest form of sophistication. The psychological demon that this simple approach slays is called action bias. This is our innate, and often counterproductive, urge to act, to do something, in situations of uncertainty. When we face a problem, our default instinct is to intervene. In ancestral environments, this was a survival trait. If you heard a rustle in the bushes, it was better to throw a rock than to stand still. But in the modern world of investing, this instinct is a liability. When the market is volatile, our action bias screams at us to do something, sell, buy, reallocate. It feels irresponsible and passive to just sit there and let your plan work. This is why so many investors are constantly tinkering with their portfolios, chasing last year's winners, selling stocks after a small dip, and generally churning their accounts in a way that generates lots of fees and taxes, but very little in the way of excess returns. They are confusing activity with progress. The index fund strategy is a form of disciplined inaction. It requires you to fight the powerful psychological urge to meddle. It's an understanding that your greatest enemy as an investor is often the person you see in the mirror, and the best strategy is to create a system that ties your own hands and prevents you from acting on your worst impulses. So how do you build a fortress of simplicity and patience in your own financial life? The applied mental model is the set it and forget it manifesto. This is a short, personal document you create to serve as your behavioral guide. Step 1 is to define your why. At the top of a single page, write down your primary financial goals and your time horizon. I'm investing to achieve financial independence by age 60 in 25 years so that I can travel and spend time with my grandchildren. This why is your anchor in a storm. It reminds you that you are not playing a short-term game. Step 2 is to codify your simple plan. Write it down. I will automatically invest $1,000 per month into a low-cost S&P 500 index fund. My asset allocation will be 90% stocks and 10% bonds. Step 3 is to commit to strategic ignorance. This is the hardest part. Write this pledge. I will delete the stock market app from my phone. I will not check my portfolio balance more than twice per year. I will not watch financial news networks. This is not about being uninformed. It's about protecting yourself from the emotional noise that leads to bad decisions. Step 4 is to create a mantra for market turmoil. Write down a phrase you will repeat to yourself when you hear a scary headline or a hot tip from a friend. Something like, "This is noise, not signal. My plan is designed for this. My patience will be rewarded." This one-page manifesto is not a financial plan. It is a behavioral contract with your future self. It is a tool for cultivating the patience required to let the simple magic of compounding do its work. The antithesis to this patient, humble approach is the tragic figure of the gambler. This individual doesn't view the stock market as a mechanism for long-term ownership in businesses, but as a high-stakes casino. They aren't interested in the slow, steady accumulation of wealth. They are chasing the dopamine hit of the big, fast win. They are drawn to the most speculative corners of the market: penny stocks, highly leveraged options trading, meme stocks hyped on social media. They don't talk about price-to-earnings ratios. They talk about squeezes and diamond hands. Their financial decisions are driven not by analysis, but by adrenaline and social contagion. They might experience a few thrilling wins, which only serves to reinforce their risky behavior, a classic feature of gambling addiction. But over time, the laws of probability and risk management are unforgiving. They suffer catastrophic losses, often amplified by trading on margin, borrowed money, which can wipe out their entire account. The gambler's path is paved with extreme stress, sleepless nights, and the high likelihood of financial ruin. It is the polar opposite of Buffett's philosophy, which is rooted in risk mitigation, business analysis, and a calm, rational temperament. The gambler seeks excitement. The investor seeks results. The direct financial connection of simplicity and patience is the mitigation of a hidden cost far greater than any management fee, the behavioral drag. For decades, research firms like Dalbar have published studies on the, quote, behavior gap. This is the often massive difference between the reported time-weighted return of an investment fund and the actual dollar-weighted return that the average investor in that fund receives. For example, a fund might report a 10% average annual return over 20 years, but the average investor in that fund might have only earned 7%. Where did the missing 3% per year go? It was lost to bad behavior. It was destroyed by the investor's tendency to buy the fund after a period of strong performance, buying high, and sell it after a period of poor performance, selling low. This behavior gap, this self-inflicted wound, is the single largest destroyer of wealth for most individual investors. A simple, automated, set-it-and-forget-it strategy of investing in a low-cost index fund dramatically narrows this gap. Because you are not making active decisions, you cannot be tempted to make emotionally driven timing mistakes. You are simply buying consistently through good times and bad. This discipline doesn't just save you from the tyranny of fees, it saves you from the far more destructive tyranny of your own irrational instincts. The financial benefit of good behavior, patiently executed over a lifetime, is measured not in basis points, but in hundreds of thousands or even millions of dollars. All of these pillars, the futility of active management, the power of owning American business, the tyranny of costs, and the virtue of simplicity, converge on one final powerful idea. This is the fifth pillar, the capstone of the entire philosophy. It elevates the discussion from mere portfolio management to a question of ultimate purpose. This is about creating a legacy, about making the final promise. It is about aligning your portfolio not with the market's chaotic whims, but with the quiet, long-term needs of your own life and the lives of those you care about most. The foundational anecdote for this pillar is the most powerful proof point in the entire Buffett canon. It is not about an investment he made for his company, but about the instructions he has laid out for his family. In his 2013 annual letter to Berkshire Hathaway shareholders, Warren Buffett disclosed the specific instructions he has put in his will for the trustee who will manage the inheritance he leaves for his wife, Astrid. This is, by any measure, the ultimate test of his conviction. This is not advice for the general public. This is a mandate for the financial security of the person he loves most. After a lifetime spent becoming the most legendary stock picker in history, building a fortune by identifying and investing in specific companies, what complex, sophisticated strategy did he prescribe for her? He wrote, "My advice to the trustee could not be more simple. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. I suggest Vanguard's. Let the weight of that statement settle in. No individual stocks, no active managers, no hedge funds, no private equity. Just the simplest possible portfolio imaginable." He went on to say, "I believe the trust's long-term results from this policy will be superior to those attained by most investors, whether pension funds, institutions, or individuals who employ high-fee managers." This is the ultimate tell. It is his final promise. When it came to the money that mattered most, the money meant to provide a lifetime of security for his family, he chose the strategy he has been advocating for the rest of us. He is not saying, "Do as I say, not as I do." He is saying, "Do as I have instructed my own family to do." This single paragraph from his will is a more powerful endorsement of passive index fund investing than 1,000 academic studies. It cuts through all the noise and complexity of the financial industry and reveals the simple, elegant truth at the core of his philosophy. The psychological principle that underpins this final pillar is the power of goal setting and having a North Star. A portfolio that exists simply to make money or beat the market is a portfolio without a soul. It is an abstract scoreboard, and its daily fluctuations can cause immense psychological stress. The market is an opponent you cannot control. Trying to beat it is a recipe for anxiety. However, when you redefine the purpose of your portfolio, everything changes. The goal is not to beat the market. The goal is to reliably fund your life. The goal is to have enough money to retire with dignity, to pay for a child's education, to achieve a state of financial freedom where your time is your own. These are tangible, meaningful, human goals. By connecting your investment strategy to these concrete life outcomes, you change your relationship with market volatility. A 20% market downturn is no longer a personal failure or a sign that you've been beaten. It is simply a temporary dip on a very long journey toward a well-defined destination. Your North Star, your life goal, remains fixed on the horizon, and you understand that the market's short-term movements are just weather patterns you have to navigate along the way. This goal-oriented mindset reduces fear, promotes patience, and provides the emotional resilience needed to stay the course. The applied mental model for this is to create your own one-page investment policy statement, or IPS. This is a practice used by large institutions, but it's even more powerful for an individual. It's a simple document that serves as your personal financial constitution. It has 4 sections. Section 1. My guiding philosophy and goals. Here you write down your why, as we discussed earlier, and your core beliefs. For example, my philosophy is that long-term, low-cost, passive investing is the most reliable path to wealth. My goal is to accumulate $1.5 million by age 65 to fund a secure retirement. Section 2. My asset allocation. This is where you define your strategy. My target allocation is 85% in a global stock market index fund and 15% in a total bond market index fund. Section 3. My implementation plan. This details the how. I will automatically contribute $1.200 per month. I will rebalance my portfolio once a year on my birthday if my allocation deviates by more than 5% from my target. Section 4. My behavioral rules. This is your contract with yourself. I will not make changes to my plan based on market forecasts or media headlines. I will not panic sell during a market crash. I will review this IPS once a year to ensure it still aligns with my life goals. Creating this document takes less than an hour, but it is one of the most valuable hours you will ever spend. It externalizes your rational plan, making it a firm object you can refer to during moments of emotional weakness. It is your defense against fear and greed. The antithesis of this planned, goal-oriented approach is the unanchored accumulator. This is the person who saves and invests without a clear purpose or strategy. Their portfolio is a chaotic jumble of investments acquired over the years. They have some of their old company's stock in a 401k, a few actively managed mutual funds their bank sold them, and a handful of individual stocks they bought on a tip. They have no coherent asset allocation, they don't know their all-in costs. Most importantly, they have no idea if they are on track to meet their goals, because they have never defined what those goals are. They don't know their number, the amount they need to comfortably retire. Because their portfolio has no anchor, they are adrift in the sea of financial news. They are vulnerable to every sales pitch from a high-fee advisor and every new investment fad that comes along, because they have no core principles to guide them. Their portfolio is a source of chronic, low-grade anxiety. It is not a tool for building a life. It is a complex, confusing problem they don't know how to solve. This lack of a plan is, in itself, a plan to fail. The direct financial connection of this final pillar is the ultimate prize, the predictability of outcomes. While we can never predict short-term market movements, a simple, disciplined, low-cost investment plan allows us to project a surprisingly reliable range of long-term outcomes. This is the foundation of all legitimate financial planning and wealth management. By using a simple portfolio like Buffett's 90/10 stock/bond allocation, we can look back at decades of historical data to understand the probable range of returns and volatility we can expect. This allows us to perform the most important calculation of our financial lives, determining if our savings rate and investment strategy are sufficient to fund our retirement goals. We can use tools like the 4% rule of thumb, which suggests you can safely withdraw 4% of your starting retirement portfolio value each year without depleting your principal. If you want a retirement income of $60,000 per year, you know you need to accumulate a nest egg of approximately $1.5 million. With that target number in mind, you can work backward to calculate how much you need to save and invest each month to get there. The simple S&P 500 strategy transforms retirement planning from a nebulous guessing game into a clear mathematical problem. It provides a clear, reliable, and achievable path to true financial freedom. It is the final piece of the puzzle, the strategy that not only builds wealth, but connects that wealth to a life of security, purpose, and peace of mind. It is, in the end, the fulfillment of Warren Buffett's final promise. You have just been given a powerful piece of machinery. You now possess the single most effective financial tool recommended by the world's greatest investor, a strategy validated by a million-dollar bet and confirmed by decades of data. You understand why active management fails, why owning American business is a powerful tailwind, why costs are a catastrophic enemy, and why a simple, patient plan is the ultimate weapon. This knowledge, when applied, can fundamentally alter your financial destiny. But understanding what to buy is only the first dimension of the Buffett-Munger system of wealth. It is the foundation, the sturdy ship that will carry you across the ocean. But a ship, no matter how well built, is useless without the courage and wisdom to navigate the inevitable storms. The second and perhaps more crucial dimension of this philosophy is understanding when to be brave. It is about mastering the psychology of deploying capital precisely at the moment when every instinct in your body is screaming at you to flee to safety. The S&P 500 index fund is the ship, but courage, rooted in rational analysis, is the wind that fills its sails and drives it forward through the tempest. The video that is now appearing on your screen has been chosen for a reason. It is designed to be the next piece of that psychological map. It decodes the specific mental framework that allowed Buffett to look at the global financial crisis of 2008 not as a catastrophe, but as the single greatest investment opportunity of his lifetime. It breaks down the mental models he uses to turn widespread fear into generational wealth. If you are satisfied with simply knowing the correct vessel to board, your journey can end here. You have a plan that will serve you well. But if you are among those who are committed to assembling the complete mental arsenal of a master, if you want to understand not just how to survive the storms, but how to harness their power to conquer your financial goals, then your path continues. You know what you must do. Continue the ascent.